Hello, welcome to the show. Welcome to this special episode with two of the top industry guests in this episode. We're doing mini series on claim litigation frequencies. There's a lot of things that cause claim litigation frequency. And in the first episode, we started off with Arizona alternative business, where we talk about non-law firms coming into the law world and how they are changing the litigation frequency. And this episode, we're going to focus on a recent event. 2021, I think we started really paying attention in the media about California fires. And January 2025, we really started off the insurance industry in the wrong direction by seeing one of the biggest fire in California history with Palisade Fire that turned into other mini fires. And I'm here with a couple experts who's going to tell us what could be the domino effects from those fires. So I'm going to introduce two people to the show, Matthew Monson and Joe Petrelli. How are you, gentlemen?
Doing well, Jeff. Thank you.
Very good. Thank you for
If
having
you
me.
guys can give our audience a quick intro of who you are, and we're going to roll right into it.
Age before beauty, I guess. I'm Joe Petrelli, president and founder of Demotech, property and casualty actuary by background. Demotech is the first company to review and rate independent, regional, and specialty property and casualty insurers. I'll fast forward to July 11th, 2022, when we were registered with the United States Securities and Exchange Commission as a nationally recognized statistical rating organization in the category of insurance companies. We review and rate from coast to coast, Hawaii and Alaska, approximately 460 companies, and as well as life and health companies and title underwriters.
And I'm Matthew Monson. I'm the owner of the Monson Law Firm. We've been in business for the past 14 years. I've been practicing law for 28 years. We have offices in Florida and in Texas and in Louisiana, and we mainly represent insurance companies and their policyholders when they're sued.
Great. Matthew, I want to start with you. Just give our audience who's really, if they're under the rock and not paying attention to the California fire, if you can just do the outline of what happened and then what do you think the potential domino effects are? And Joe, you fill in your expertise after Matthew.
Certainly, thank you. What we've had was obviously, a disaster of just gigantic scale in fires in which people's lives are radically changed in multiple fires that took place in California. Our heart goes out to them. It's a really terrible thing that took place. But what we're kind of here to discuss is what are the insurance impacts? How is this going to affect both the industry in California and the insurance industry going forward? Heading into this, the kind of challenge was that the California marketplace was already in turmoil. You had insurance companies that were asking the regulators for the rates that they felt was necessary to address the risk that was taking place, especially with the wildfires over there in California. And they were getting a lot of pushback because from regulators, and regulators did not want them to receive the rates that they got. So even almost a year before these fires took place, the California marketplace was in turmoil because the insurance companies did not receive approval for the rates that they thought were sufficient to protect them from this risk. And as a result, the insurance companies started canceling and or non-renewing policies en masse and essentially leaving the state and causing rates to rise with the surplus lines market that kind of stepped into place. So it was really not a good scene to begin with. And with that, then you throw these horrible fires in place, right? It exposes the wounds that were in the process of beginning to heal with some of the efforts that the regulators are starting to take at the very end of 2024. And so that's kind of, I guess, sets the stage that we had a really bad situation to begin with. And, and the pressure has been put on that same bad situation already with these horrible fires.
From my memory as an insurance agent, it's been going on for what, 5, 6, maybe even longer, 7 years, 8 years of insurance carrier complaining they cannot get the right rate for California, because they were filing for rate increases and some of it was blocked. Is that accurate?
Um, uh, I don't know on the specific details of it, but what I do know and understand that and we can look at Florida as an example. When you have years worth of rate increases that are not allowed, those they kind of build on each other. So if you need a 5 or 10% rate increase a year, by the time you get to year 6 or 7, you might be 60 or 70% below where you need to be. And that's the problem. And if you need a 10% on top of a 10%, it's not 20%. It just keeps growing on itself almost exponentially. And so so over time, if you're in a situation where rate increases are rejected, it becomes a situation that that we face today, where the carriers need gigantic rate increases just to keep doing business. And then you get yourself in an emergency situation. Of course, from a political standpoint, it works really well when there's no major disasters. Hey, the rates are low, everybody gets to buy houses wherever they want. You don't have to worry about true mitigation tactics or anything like that, right? And you start getting away though from some basic insurance principles. And so and then all of a sudden when you have a big loss like this, it happened in Louisiana after Katrina, it happened in Florida, and now it's being revealed in California. And I think it's just very unfortunate, for the people of California and the average consumer who doesn't get to see this. And hopefully, some people will get to watch what we're talking about and understand that this problem is not an overnight problem. It might be affecting them from an overnight perspective, and it's a shock to the system, especially when you consider what's generally going on with an inflationary economy. People don't have the money for these 70% rate increases that are going to be facing them. And unfortunately, though, it's something that has been developing for quite a period of time.
Just to add comparisons for our audience when you listen to this. When we talk about rates comparison for states, what insurance carrier might be looking at? I'm on a website called bankrate.com, where they take in data from state, national carriers, regional carriers, and how much premium do you have in my state, how many homes do you insure, and they put out the average numbers. Some of the biggest states here, Texas state average is $39.73 for homeowner premium of 300,000 dwelling coverage on average. Florida, same thing, $54.88. Louisiana, $41.35. And a very interesting one yesterday caught my eyes. Nebraska, $56.40. And California average premium for 300,000 dwelling is $1,429. The national average is $22.58, and California average homeowner premium is $800 below that. So just for perspective from an insurance carrier, when we're looking about same cost, if not more expensive, replacement materials, cost of homes are higher based on the average home premium price, average home prices. So, yeah, so that right there tell you a lot about the pressure the insurance carrier probably facing every single day.
Certainly. And again, money can flow from state to state. We have, every state has different regulations. Every state has different challenges in the marketplace. And state regulation, I believe, is the best way to continue to go forward. But if you are an insurance company, where would you want to put your money at risk? If those numbers are accurate, would you want to put that your money at risk in California, where you're getting maybe 1/3 of what other states are charging? No. And so the money will flow, unfortunately, with all this, out of California into these other states. And the people from in California, they need the insurance coverage, right? They need insurance. Insurance is the lifeblood to our economic system. It really is. And so if insurers just say, hey, look, we are not going to play in this sandbox, because if we write business at that price, we will lose money, right? You can't force somebody to lose money. And that's unfortunately the circumstance that appears to be developing.
let me, and this is, Matthew, you mentioned basics, and Jeff, you gave us some examples of premium levels. Let's say we look at it, I think it was around a $2,400 average that you mentioned. And I'll say this too in advance. Anytime you're at an insurance meeting, the smartest people in the room are the reinsurers. So we got a $2,400 average nationally. And I think you said there's about a $1,500 average in California. Is that right? Okay. So let's say that the cost of reinsurance on a national basis, the reinsurers are not, they're indifferent as to what you are charging your customers. What they are interested in is how much do we deserve for the protection we're going to give you. So let's say on a national basis, and let's call it $2,500 average. Let's say they decide they need 40%, $1,000 of that $2,500, and $1,000 per policy average is what they need. Well, for the national average, that 40% to get $1,000 works. However, if you're charging $1,500 in California per policy and the reinsurers want $1,000, it's no longer 40%. It's 2/3. It's 1,000 over 1,500. So the primary rate of the company, what it's charging its consumers and policyholders, is being squeezed by the cost of the proper cost of reinsurance. So when companies apply for a rate increase, sometimes it's because they need additional monies because the cost of lumber, glass, tar paper, shingles, carpeting, all that goes up. But other times there is pressure on them for their reinsurance costs. And I think when you look at the reinsurers and you look at a specific situation, whether it's flooding, hurricane, wildfire, they have models too. They're working with the modeling companies. They have some estimates of what the cost for the company would be. And when they model a particular insurer, that insurer is actually providing a specific list of its clients. We're talking street addresses, zip codes, all that. Is it masonry? Is it frame? Is it a slate roof? Is it a wood roof? Is it a tar paper roof? Is it a shingled roof? All the characteristics of the building and the structure, the home or the property, is being fed into the models. So when you have a situation, and we'll use California as an example, where you have a high concentration of business in the area that was adversely impacted by the Palisades fires, the reinsurers were charging those companies the premium they thought was proper, whether there's fires or not, because they're charging for the exposure and the risk. They're not charging for the actual event. They're charging you for the risk. And reinsurance is like our homeowner's premium. We pay that reinsurance cost as an insurance company, and it's gone. If there's no fires, there's no wind blows, there's no floods, we still paid it. The same way you could be loss free. And on your homeowners, you don't get that money back. You paid for the protection. And so at any given point in time, over the past several years, when there were no fires, the companies were still paying dearly for reinsurance because the reinsurers were modeling that and were charging the companies a reinsurance premium that they felt was proper.
I just pulled some similar statistics with two other states who have seen pressure from wildfires. Not as much wildfire because they're much smaller states. Colorado annual average premium is $31.67. Arizona is $22.45. And that compared to the California average of $14.29. So just for some statistics, if you were fast forward to October 2025, and this question could be for both of you guys, where the annual renewal come out for reinsurance, what does that look like if you're in the room of California?
Well, I'll be glad to take that first, Matthew. But I think on those numbers you just gave us, Colorado 31.67, Arizona 22.45. I think the other thing that we have to take into account is a $300,000 home in the Los Angeles area, I would think is essentially a bungalow, right? So the dollar amounts are going to be much higher in California, and on the amount of insurance curve for an insurance company, the cost of a $300,000 home versus a $600,000 home, it's not double, it's graduated, it's less than double. There's a scale associated with that. So you have a compounding effect in areas with high coverage A amounts, high home values, because of the amount of insurance curve decreasing over time. So there is a confluence of insurance rating algorithms that adversely impact states with very high values in their homes and in their buildings. That being said, back to the reinsurance question, I think from my perspective, the cost of reinsurance has been factored in even during the years when there was no claims and there were no fires. So to a certain extent, what's going to happen is they're going to use Palisades and Eaton and the other fires to recalibrate their models. And now they're going to readjust based on the actual experience as opposed to what they thought might happen based on the models when there was no fire. So I don't think it's going to be all that dramatic. However, there is going to be an increase because I think these fires are much worse than people thought they'd be. The second thing will be if the underlying conditions that facilitated the fires of this magnitude are not readily and quickly addressed, then the reinsurers, I think, will take the position that it could happen again because we haven't addressed underlying causes. So I think there'll be some increases. There'll be certainly in a closed room, there'll be some I told you so's. But I think the key thing is we'll have the underlying conditions mediated or remediated the future possibility of similar losses. And certainly, I probably should have said this earlier, and I know I speak for the three of us, the human tragedy of these fires is well beyond the economic tragedy of these fires. So the real question would be, if these homes are not rebuilt, if these businesses are not rebuilt, will the companies even have something to charge a premium on? I mean, we've lost, what, 20,000 structures. There was a premium associated with those 20,000 structures. To the extent they're not yet built back in October of 2025, the company basis of premium have lost 20,000 structures. So where's the money going to come from? Have the underlying conditions been addressed? And yes, sadly, there probably will be rate increases.
Right. And just to chime in just a little bit, and I agree with everything that Joe said. The question can even go out further beyond October 2025. What are we looking at over the next several years, right? I think, what California has revealed is something that's quite true, that number one, rent control does not work, right? You can't artificially hold back prices of things. And there's consequences to that. And unfortunately, we're going to see the consequences of that. And you have to let, and while as painful as it may be, you have to let the free market work. Ultimately, prices are going to have to rise, and they're going to have to rise in a manner of which will make a lot of people very uncomfortable, and even to the point where people might not be able to afford it. And that's going to be extremely unfortunate. But again, the seeds were planted for this years ago, right? And the consequences are going to reveal themselves over the next several years. But in general, the best solution to high insurance rates, in fact, is high insurance rates. When you truly look at this, right? And we're seeing this in some of the other states. You have two issues. It's not just high rates, right? It's affordability, which certainly is there, right? And that's what we're talking about. But it's also availability. And I think what we're going to end up having to deal with, right, is the lack of availability of insurance under the current framework, right? Once we allow carriers to charge what they need to charge and put them in a positive environment so that they can make money, because an insurance company needs to make money in order to pay claims. They have to be profitable in order to be there at the times of crisis that we're facing now. So it's incumbent upon California and their regulators to create an environment that's positive for the insurance companies, that allows insurance companies to be profitable so they can be there to pay these claims. And then once we address that, the first thing first is availability. You're seeing Florida right now. Florida in their circumstance and the crisis that they've come from, that, from a regulatory standpoint, they've made some massive improvements over the last 2 years. And those improvements have resulted in 10 brand new insurance companies being created in Florida. Now, those companies are taking policies out of Florida citizens. There's a circumstance where Florida Citizens again has dropped in its number of policies by almost 500,000 over the past year, and it's entering the private market.
Matthew, if you can, for our audience, tell them who Florida Citizen is. So
Okay,
a little
so-
background.
No, thank you for that. So, Florida Citizens is the insurance company of last resort. When you can't get insurance from the private market, it's available for you in Florida Citizens. Just like in California, it's I guess a brother in arms, a sister in arms, is the California Fair Plan. If a private insurer will not write you, you generally can go to the California Fair Plan and get coverage. And so from that standpoint, the insurer of last resort in Florida, after 2 years, after multiple years of changes, there's green shoots over there. There's hope in Florida. But the hope right now in Florida, for the most part, has been in availability. You finally have availability again in Florida. Affordability rates are just beginning to come down. They're off the mountaintop. They're not down as far as people would like, and quite frankly, not as far as the insurance companies would like. Right. But once you have the availability, then you can begin to address affordability. And of course, from a political standpoint and from a practical standpoint in people's daily lives, the only thing I guess to them that matters is affordability. Unfortunately, it's going to take a period of years for the market to settle down, to get to the point that where insurance can become affordable again and at the right price. But that's only provided that the regulators and the politicians do their job first. And so I'm looking forward to seeing the solutions that will be hopefully presented in the next weeks, months, and years in California.
If I may, I know the rate adequacy, the availability versus affordability issue. I mean, it's always raged in the insurance industry, particularly in personal lines. You look at automobile insurance and personal automobile and homeowners insurance. Approximately 55% auto liability, auto physical damage, and homeowners, almost 55% of the premium in the country for the P&C market. But let's look at Florida and California from a different perspective. Let's look at them just from a geographical perspective. I mean, Florida is a narrow peninsula between two bodies of water that tend to get warm. It's not a matter of will there be hurricanes. It's a matter of how many will there be and when will they come. And oh, by the way, we're 100 miles from east to west. So it's a very narrow peninsula. It's exposed, and it's in the worst possible place. If it was up in Antarctica, I wouldn't have to worry about hurricanes. But it's down where there's two warm bodies of water on both sides. And then when we talk about availability and affordability in California, then let's look at the LA area. It's famous, great weather, great sporting events right near the ocean. It's a gorgeous area. However, it's not just the fire exposure. They've got earthquake. They've got mudslides. So the cost of coverage is consistent with the geography. It is intrinsic in the geography of Florida, and it's intrinsic in the geography of California. California is located where it is. It's not going to get up and move east. It extends from the north to the south of the country. It's got every exposure because it is, in fact, representative of every latitude from top to bottom. So part of this is intrinsic. You can't, if you want to make your policy cheaper by excluding earthquake in California and excluding mudslide, you can do that, but it's not practical because those are exposures that exist. So I think I'm coming full circle. I'm with Matthew. Affordability is a personal concept. Buying the right coverage might be a more objective criterion. And perhaps everybody in California should be basing their estimate of their premium on my earthquake, mudslide, homeowners, with all those coverages combined, and look at that number, because that is the exposure that your geography gives to you. It's not like people are making it up. We don't have mudslides in Nebraska. We don't have that. We don't have the earthquake exposure in other states. We have some, but not what you have in California. So, I mean, those are things that we have to take into account, is that the legislature, the insurance departments, the geography is dealing them some of the cards they have to play.
Let's talk about current situation right now. The fire started in early January, right? And some of the numbers here. Fair Plan gets 4,400 insurance claims from LA County. And just Pacific Palisades, 3,200 claims. When we talk about a state like Florida, there's a lot of emergency personnel that used to planning against hurricanes that have decades of experience in emergency response on a state standpoint. And also any insurance carrier there, they know they have to summon all the claim adjusters in one place at a very, very fast speed. What does that look like on the ground in terms of handling claims from public claim adjusters, third-party claims, carrier claim adjusters? What do you guys think how this incident is shaping out?
Well, I think, well, go ahead, Joe.
No, I was going to say, I mean, at a real high level, I view what's happened in the fires and in LA. I think that those claims are going to take decades. We'll be talking about this certainly into my retirement, probably into maybe even into the two of you's retirement. I mean, I think that the breadth and depth of the types of claims, even the total losses, where there's no question it's a total loss, there will be negotiations, discussions, and litigations about what that total loss should be in terms of dollars. I mean, I just think this is a nightmare scenario for everyone, whether it's the Fair Plan or a private company. And I see it as being all but another asbestos. Matthew?
Yeah, one of the challenges, I'm looking at some articles, that are trying to, estimate the exposure to the Fair Plan in particular. And that, they think that there's approximately a $4.8 billion, exposure over there. And there's, questions that are going on right now. And I guess, in the future, we'll just find out what it is. But that whether or not there's going to be an assessment on the carriers in California. I think the way that if the Fair Plan essentially runs out of money, and I don't know if that'll happen or not, that that they will have to assess. And I think the way that process works, and correct me if I'm wrong, please, Joe, is that they assess the carriers in California, which of course puts a further economic burden on them. That they'll have to pass on to policyholders to the extent that the law allows them to. And so, so from that standpoint, it's quite troublesome. And the estimates generally, I believe that, taking place now, those are estimates. They're not reality, right? The lawyers are already lining up over there, and paying off a total loss house in California, that's generally not difficult to do, right? You see the house is burned to the ground, you know what the cause of loss is, right? The challenges, I think, going forward are going to be the people that bring on the smoke claims, right? Smoke covered the entire Los Angeles area. There's been prominent property plaintiff law firms that are already advertising that, here it says you're going to have to replace everything inside of your house, all your contents, all your carpet, all your sheetrock, which, essentially trying to turn a smoke claim into a total loss for consumers. And they're gonna, if you're an insurance company, you're going to be challenged because you're going to be in a situation where everybody knows somebody who lost everything. Right.
Yep.
It's one of those massive disasters, and the juries are going to be very, very sympathetic to somebody's somebody's claims. But I think the smoke claims are going to be what turns these initial estimates and makes them look small. And
Yep.
then you're challenging the reinsurance limits that are out there, period. You're challenging the solvency of companies, and certainly going to potentially be in a circumstance where the FAIR Plan, depending on the coverages, because it's my understanding the FAIR Plan does not necessarily provide as much coverage when it comes to smoke as maybe the private market will. But it's going to challenge the whole economic system that's in place.
Let me say, if I could, I indicated I thought this was going to be the equivalent of the asbestos claims of the 60s and go on forever. Let's use smoke as an example. Again, going back to the LA area, the geography, the weather, I'm guessing more convertibles in the LA area as a percentage of cars in the area. The convertible tops are going to absorb smoke. The rugs in the cars, carpets in the cars are going to absorb smoke. The seats are, if they're cloth, and you're 5 miles away from the fire. So, I mean, the number of smoke claims, I think Matthew's dead on. I think he was one of the first to write about that, maybe the first. But the smoke part of this is going to be everywhere. It's houses, it's cars. You have a store and you sell carpets and the smoke gets in and now all your carpets smell like smoke. I mean, it goes on and on. Anything that can absorb the smell of smoke probably has. And this is the dilemma, is this thing is going to unfold over time, and the economic cost is going to continue to increase, not decrease. And for the companies, the insurance companies that bought reinsurance, they have a retention. The same way that when we buy a policy, we have a deductible. And it could be $1,000, it could be $500, whatever our deductible is, and all of the loss above that goes towards our insurance company. The insurance companies do the same thing for a catastrophe. They have a limit of 5,000, 50,000, 250 million, whatever it might be, but they still have a limit. And 100% of what's over that limit goes to the reinsurance community. So what's happening here is the uncertainty associated with this is going to be fall on the reinsurers. One more thought, and then I'm going to be quiet for a second. Matthew mentioned total losses. Insurance companies have a hierarchy within their claims departments where certain people have certain levels of authority to settle claims. When you start getting into $2, $3, $4, $5 million total losses, there's going to be multiple layers of claims people that approve that claim. It's a process. And I don't know, every company's a little different, but there's going to be multiple approvals that need to go through the system. And with the number of total losses that exist in LA, there will be people with that authority in the 2 to 10 million range that are going to be looking at more items in 1 week than they probably have seen in their careers at those companies. So this is a true test of everything associated with it, whether it's the infrastructure in California, it was a test, the insurance community to respond, the ability of reinsurance models to predict the right number, the ability of claims departments to have the appropriate flow of information up to the people that have the authority to sign checks. This is unprecedented in its frequency of claims, the number of claims, and unprecedented in the severity of those claims. And on top of it, you'll then have, for years, smoke claims. I can see it. And it's not going to be pretty.
Another challenge that I've seen advertised already from, again, yet another prominent plaintiff firm is the assault on insurance producers. They're already preparing that circumstance. The agents, the brokers that deal with the public because of lack of adequate amounts of insurance. I mean, obviously underinsurance is something that has been I guess really a problem all over the place, throughout the country, where people, in order to be able to afford insurance, when when they go to an insurance producer, that conversation, we all know that, happens quite often. Hey, I can't afford this, right? And so sometimes insurance producers, in order to make the sale or to provide some level of protection for their policyholder, reduce the limits of the policy, reduce the contents limits, reduce the structure limits on the policy. And so unfortunately, some people are being caught in that circumstance. The lawyers are already looking to blame the agents and the producers when in fact, in a lot of those circumstances, I can imagine the policyholder going along, with that just for affordability's sake. And so that is also, and again, already being advertised, already openly saying, hey, look, we can do this, we can go after your people, that provided you, with the service. And so, so the repercussions of this, have not even been felt yet. Like Joe says, this is going to take place for years, and it's really going to unfortunately reshape the entire California marketplace.
Yeah, no, if I could jump in on that one, I mean, the insurance agent, whether or broker, I mean, you're working directly with a consumer. It's tough to tell your customer, I told you so, but I'm hoping in terms of litigation that many of those customer service representatives, those agencies, and those people that work directly with the consumer, that in fact they have a note in their file that says, I told you to buy $5 million of coverage. You said you couldn't afford it. You only want to buy 3. So here's your quote for 3, because it's going to be, again, to Matthew's point, it's going to be ugly if that agent does not have some documentation that is written and procedural that says, hey, you should have bought more. I told you should have bought more. And this is on you, not me. Because if it's murky and there's no documentation, and it's like, well, I told him on, Tuesday the 18th that he should have bought more, but there's no evidence, it's going to be problematic. And again, it's another series of litigations that will go on for decades.
We're talking about insurance carriers, right? Their rates, their entry into the state is dictated by state regulators. And right now, the biggest insurance carrier that's in the media, at least media talk about, is the biggest private insurance carrier, which is State Farm, and also the state-backed insurance, which is California Fair Plan, right? And I'm on LinkedIn and just doing some Googling, and here's some statistics on California Fair Plan. They went from $50 billion in total property value insured to $458 billion from 2018 to 2024. $50 billion of property insured to $458 billion. And that is a massive number. Here's some of the cancellations that's initiated by insurance companies from 2015 to 2021. This is by CDI fact sheet, data on insurance non-renew and fair plan. This is by year: 141,000, 141,000, 140,000, 140,000, 189,000 in 2019, 238,000 in 2020, 268,000 in 2021. I don't have a statistic on 2022, 2023. I'm pretty sure the non-renewed by insurance carrier is just as much higher. And then here's the number of new business policy written by the last resort. Like, they're the last people that nobody else can get, and they're the last choice of options, right? 2015, this is in terms of the total market share, okay? 1.7%, 1.6%, 1.6%, 1.6%. 2019, 2.1%. 2020, 2.7%, 2021, 3%. And the reason I'm outlining these numbers to give our audience a measurement of what's been happening. I'm just looking at LinkedIn of California Fair Plan, which anybody can go to look. They have 145 total employees, right? Handling the number of claims that we just talked about. Like, when I think about a massive insurance company have this much books on their balance sheet, I just think they're usually a little bit bigger. Am I wrong on that?
Let's talk about the fair plan from a couple of different perspectives. And every state's a little different on the funding of their fair plans, but rough cuts, the assessments that will come out of the FAIR Plan for the insurance companies are going to be basically essentially based on market share. So if there's an assessment of X dollars from the FAIR Plan and you have 10% of the premium volume in the lines that are assessable, you're going to pay 1/10 of that X. So the assessments are going to be based on proportionality, and it's historical proportionality. So it's going to change over time. It's going to roll forward year by year. That assessment is not going to be one and done. It's going to be an annual assessment, sort of on a pay-as-you-go basis to permit the FAIR Plan to settle claims. And then the next year, there'll be another assessment to settle the claims coming up then. And then the third year, another, fourth year, out and out. So the uncertainty associated with the marketplace in general is compounded by the assessment you're going to get from the FAIR Plan. Because I can settle my own claims. I have a sense of those. But what I don't know is what's my assessment from the FAIR Plan going to be. And it's going to be continuous, and it's going to be over that entire period of time it takes to settle all these claims. So for the company's perspective, it's now riskier in California because these fires occurred, and they're likely to get assessments from the FAIR Plan. That being said, in terms of the funding of it and the uncertainty it gives the companies, back to your question, I would say if the 145 employees, to the extent that that's the right number, and that's the published number, they're going to have to secure independent adjusters to help them. There's just no way they could do it on their own. That being said, when you talk about the amount of business that's been written in the FAIR Plan over the last several years and how it's grown, they are not going to be immune from the lawsuits either. So it's not like the FAIR Plan is going to have a clean deal dealing with consumers and being done. They're going to be dealing with attorneys as well. Every insurance company, including the FAIR Plan, faces the risk of litigation and discussion on what's covered and what's not. And to the extent that there's, if I could make an analogy, Matthew was talking about how the insurance agents and the brokers will be perhaps litigated because they didn't offer the coverage or the coverage limits they should have. The same thing will be applicable to the FAIR Plan, even though there's statutory limits and there's statutory provisions. I would think that those would be challenged as well by an innovative litigator.
Yes, I'm looking at actually something for the FAIR Plan that's dated January 30th, 2025. They have staffed up through, I'm sure, through the use of independent adjusters in order to, they say they're maintaining expanded staffing levels comprising of approximately 250 desk examiners and field adjusters working on claims. And they mentioned that they use independent adjusting firms and contract with third-party catastrophe examiners and adjusters. So if they can rely on, hopefully the good people in the adjusting industry, through contract to be able to process these claims.
But and I say you have the same situation at the California FAIR Plan that you have at insurance companies, in that every adjuster at the California FAIR Plan does not have unlimited signing authority. There's going to be a process where approvals based on the dollar amount of the loss and the check to be written, there's a process. So people aren't going to be able to walk in, get a check from the person that's settling their claim. There's a process involved, and several supervisory levels are going to need to approve claims of certain dollar amounts. It's standard procedure, and I'm sure it's in place at the California FAIR Plan to some extent.
Yeah, the insurance regulators too, as far as adjusters, it's something that's concerning, but hopefully not so much. The Insurance Commissioner's Office issued an emergency order as part of their declaration of the emergency situation that's going on over there, that actually allows non-licensed adjusters, as long as they're working under the direction and control of a qualified licensed adjuster, over in California. One of the things that is a little concerning there, is that hopefully that while they might not have a California license, You have adjusters that are licensed and experienced in other states that can come over to help California, to address any kind of staffing concerns that may be developing.
It's interesting that we're watching how Fair Plan handling things. It would shape how other states handling their fair plans or their citizens for years to come. But recently, State Farm is in the news. They applied for 22% emergency rate hike. I'm assuming that's say, hey, before, we need this rate hike within 30, 60, 45 days, whatever that is, in order to stay solvent. And that's a big news because State Farm is the biggest property casualty personal insurance carrier in the country. And here's a list of top 10, just for the audience. Top 10 property insurance carriers in the state of California based on premium written on homeowner insurance. State Farm, Farmers, CSAA, Liberty Mutual, Mercury, Allstate, USA, Auto Club, Travelers, and the last one is American Family. And whether it's the news that's being broadcasted from covering the claims in California or anywhere else, or even have to do with United Health CEO being assassinated, the first time ever, to my knowledge, that all property and casualty insurance carriers pull out of Super Bowl. So as of recording February 8th, tomorrow is a big game. 204 million Americans will be watching the Super Bowl, the most singular, biggest watch event. And there will not be a single property insurance carrier that will be participating in that TV spot. That is wild to me.
I'll jump in. I'll jump in on that, Jeff. I think there's a couple things going on there. Number one is they're going to deploy those financial resources to the settlement of the claims. And then implicitly, there's, I believe, an element of respect for the human tragedy that is now California with the wildfires. So, I mean, I get it. They're they're keeping their powder dry to settle claims with it. And I think that's part of that uncertainty. They don't know what the claims are going to be. They don't know what the litigation environment is going to be. They don't know what their reinsurance costs are going to be in the future. And they don't know what the assessments from the California Fair Plan are going to be in the future. It's the same way that a family would cancel a vacation when they lose their job, right? They're trying to be prudent. And yeah, I'm sure it'll be odd to not have an insurance commercial at the Super Bowl, but there's nothing that is of historical comparability to what's going on in LA. So I think that this is something that we all need to kind of recognize, as this is a very unusual, once in a lifetime situation, and everybody is going to be going at it, whether it's the Fair Plan, the good folks at the California department, the insurance company adjusters, everybody's going into this trying to do the right thing, but there's nothing like it in the history of the insurance industry.
Right. When you consider State Farm in particular, again, this is their challenges in California predated these fires by a good bit.
Yeah.
And the whole idea, State Farm is the biggest writer in California. Obviously, they're pretty much the biggest, personal lines carrier in the country. And so they've always been known to be, financially strong, financially certain. Well, another rating agency back in March 2024 downgraded one of State Farm's carriers called State Farm General from an A, which is excellent, for that rating companies to B, fair. And for a State Farm entity to be downgraded from an A was gigantic news, and remains gigantic news, to this date. And State Farm General is the subsidiary of State Farm that operates over in California, and so that was, I guess, the canary in the coal mine when you saw that now it's getting real. And then State Farm started their process of saying, hey, look, guys, we are going to non-renew. We're going to shrink our book of business, because when an insurance company wants to be profitable in times of trouble, the best approach, in my mind, is not to write more business at very low rates, because that's a cycle that'll just end up with the company going out of business. It's to shrink your exposure and to get your rates where they need to be from an actuarially sound standpoint to reflect the risk. And so State Farm says, hey, look, our company, they actually allowed their company, instead of putting more money into it, they said, they understood, say, hey, look, we are not getting the rates that we need, and actually allowed the carrier to get that downgrade. In the meantime, what did they start doing? They started, the phrase is pulling out of the state, but basically non-renewing and shrinking their book of business. The emergency rate increase that was just requested by State Farm is on top of rate increases that have been currently pending before the California Department of Insurance for their consideration. So it's rate increases on top of rate increases. Again, the things that we're talking about earlier, they need this in order to stay financially viable in the state of California. And the big question mark is that if they don't receive these rate increases, will they continue to provide coverage, at all in California? And that's hopefully we don't get to that point. Hopefully, the regulators, allow State Farm an amount of rate increase that's necessary to reflect the risk, and based off of real numbers and based off of reinsurance modeling. And in California, even the regulators going back into late December, and this is very celebrated. This is part of a news release that was December 13th, 2024 from the California Department of Insurance, which essentially said, hey, look, we are going to finally allow insurance carriers to write at the rates that they need. Again, December of 2024, trying to fix it. Said this is going to fix it, and they call it literally from the website, in a California first. This is an announcement. But in exchange for applying some free market principles, there is a catch. And the catch is that if you write 10% of the marketplace, you need to write 8.5% of the wildfire distressed areas. And to me, that is not something to celebrate. Insurance companies have to be able to voluntarily choose what they're going to write and what they're not going to write in order for basic insurance principles to be applied. And anytime you've had what they call an assigned risk pool, which essentially is what this this announcement shows, that hey, you're going to be assigned 85% of your statewide market share to the bad areas. That is something else that's not going to attract new insurance companies to the state, in my opinion.
Yeah, I think when to your point on the high risk areas, the cost of reinsurance per and think about individual policies. Somebody's got 25,000 homes in the state. The reinsurance cost associated with each of those homes is not pro rata. It's not 1/25,000th. It's not equal. It depends on the type of the home. It depends on where it is. So the reinsurance costs are not proportionate. They're disproportionate. And so to ask someone to write in a cat-prone area, those reinsurance costs are higher than if they thought they'd be writing in non-cat areas. So they're going to need more pricing, more rate, because they have to cover the additional reinsurance costs. It is a waterbed. You cannot just keep things constant. You push down over here, it's going to pop up over there. So all these things, there's a lot of mathematics and actuarial science that goes into this, but it is a very complicated process, and it is one where the companies need to be very careful, because they put their pricing together for a certain mix of business. And if you want to offer that a different mix of business, then you probably need a different cost structure. It's really that simple. And again, when we talk about the cost of reinsurance, it is not a blanket cost. It is very proportional to the inherent risk. And that's one of the, probably in the last 10 or 15 years, that's one of the things that's come out of the reinsurance community, is companies now have the ability at the individual policy level to determine whether writing that particular property will take a disproportionate amount of their reinsurance protection, or whether it'll take a less than disproportionate amount, and thereby leave additional reinsurance capacity for the next property. it's a fascinating dynamic, and the reinsurance community spent a lot of time and effort on this.
You guys both are advice insurance carriers, one from the litigation side, one from the rate side. A state's healthy when they have a lot more new carriers coming in to provide choices to consumer capitalism the way it should work. If you're talking about advising a company like Bamboo, Pacific Specialty, Sage Shore, Hippo, Lemonade, Branch, who haven't entered the state, I don't know if they ever will. And company like Kin Insurance maybe, and company like who are currently there. Some of these Lightspeed Specialty, right? Some of these insurtechs. What are the challenges they're facing walking to 2025, 2026?
I think I'm not going to give advice to any particular company or any one company. I think just in terms of general overview, I think the cost of the fair plan assessments over the next several years until these claims are gone, I think that's a layer of cost and uncertainty that they're facing. And I think any uncertainty in cost structure when you have investors or you hope to get additional investors, you're going to have to cover in your documentation and in your presentation. If you want to secure additional funding, you're going to have to cover that uncertainty. And I will respectfully say, with respect to the reinsurers being the smartest people in the room, I think investors are right there with the reinsurers in terms of being the smartest people in the room.
Again, I have to watch it because some of those carriers that you mentioned are clients of mine. But in general, this is when you have these big events, right? Now is your time to shine. Now is your time to take care of your policyholders, to enforce the promise that you made. And of course, every insurance policy is a promise, you know, and now's your chance to take care of people who desperately need it. To go out of your way with, while it's a lot of money, right? And we know that State Farm has already stated that they've already paid out $1 billion to policyholders, and they know it's going to be multiple times that. So it's a time to take care of the policyholders as best as humanly possible. But on the back end of that, there's going to have to be some soul searching as to whether or not you want to maintain your level of exposure in California. California is an amazing marketplace. It's got, gigantic economic opportunity, right? But you have to make sure to maintain the discipline to get the rates that you need to reflect the risk that you're insuring. And from that standpoint, that's my two general piece of advice. Take care of everybody, do the best job as possible to pay all valid and substantive claims. But moving forward, look at the numbers. The numbers are going to dictate your decision-making process there of whether or not you want to, be part of California under the current regulatory environment.
It's a long road forward. I'm with you, Matthew. I agree with everything you said. I'll just add that we should not be surprised at a high level. No one should be surprised at the length of time it's going to take to fully resolve what's transpired through the fires.
Yeah. And also, insurance company have always been trying to build their image through commercials, right? Commercials is their way of storytelling. You have these high roles like CMOs, chief people officers, these type of roles to tell whether they're a good company to work for or they're a good company to get your insurance with. And they always want to build trust on both sides, right? To work for and to get insurance with. The past month, since we are a podcast, we are a creator media, I've been studying how top 5, top 10 insurance carrier handling these circumstances they're put in. And it's just amazing to me that how very little their social media team and their senior leadership are talking about how they're handling the California wildfires. And I think at some point, this is going to be something we all look back on, however senior leadership in insurance perspective should handle their own personal brand and their company brand, talking about addressing how they handle wildfire. I'm looking at State Farm, LinkedIn, past 2 months, there's no mentions of the wildfire. And they talk about Chinese Lunar New Year. They talk about, diversity hiring. They talk about career days, but how very little is talked about on the wildfires. And at the same time, they're cutting out millions, hundreds of millions of dollars of checks to pay for claims. This is your spotlight to shine. It's, you guys mentioned all the things you guys have expertise in of how they should handle claim, how they should handle rates, reinsurance, etc. Being in the perspective of storytelling, insurance company is selling a piece of air, which is trust, and how they should be looking at storytelling going forward. I think they're behind. They're very, very behind compared to how other big 20, big 50 brand in the US, how they address storytelling and branding.
No, I agree wholeheartedly. When you look at the people who do the door knocking in the neighborhoods after a loss event, what they say is that your insurance company is going to screw you over, right? Your insurance company is going to deny your claim. Your insurance company is not going to pay something. So even before the process has begun, and and I think it would do insurance companies a great service, particularly the largest insurance companies that are out there, if that they would show the efforts, that they would, release numbers and say, hey, look, this is what we've done in a commercial type format, right? And show people who have, received their payments and are thanking the company for the good claim service that takes place. Because when you look at the amount of litigation, that might only be 5% or 7% or maybe 10% at the tops of the bad circumstance, which means for the most part, 90% of the people are satisfied with their claims process. And so to focus on that 90%, and to be able to show the whole world that insurance is going to rebuild Los Angeles, right? And that even the plaintiff attorneys that play in the marketplace, when I give speeches, I said, when there's plaintiffs and defendants in the room sometimes, I say, raise your hand if you work for the insurance industry. And of course, the insurance people raise their hands, but the plaintiffs don't. And I say, well, where do you think your money comes from? All the money for the plaintiffs, for the adjusters, for the engineers, all the people that come, that get engaged in the fight after a storm, it all comes from the insurance industry, one way or the other. And so the demonizing of the insurance industry, which obviously, resulted in a horrible circumstance over in New York City in the healthcare industry, it's just wrong. And the whole idea is, is every claims adjustment perfect? No, it's not, right? But have I ever heard of somebody in an insurance company say, well, we don't want to pay this just because we don't like them? No, that doesn't exist in the industry. It doesn't. And if it does, it needs to be ripped out and uprooted and thrown away. But the insurance industry doesn't do itself a favor by having these cartoon character type people that are in their marketing to try to sell somebody on price, right? You can save 15% here, or you can save 10% there, or 15 minutes can save you a certain amount of money. That's, while that can help make a sale, right? To be able to say, hey, look, we are the company that's taking care of people in their most desperate moments, when you have nothing, when everything you own has burned down and all that stuff. Here, this is where we are. This is, here's our people literally going to the site and showing that. And I think there's unfortunately been a very, very large missed opportunity. I'm glad you raised that question, Jeff.
Yeah, I think the commoditization of personal lines insurance, and by that I mean, cheaper's better. It's not about cheaper's better. Better's better. You need the coverage you need, and the cost is your decision on cost, but the coverage you need should be presented to you by your producer, by your insurance company. And then if you can't afford it, it's a separate issue. But I think I've been in the insurance business. I went to the College of Insurance. I always tell people when God was a boy, I've been I'm a one-trick pony. I've been in insurance my entire career. And I agree with Matthew. Every person I've met in a claims department is trying to do the right thing. And you could have disagreements about that, about what you as an insured and a policyholder and a claimant think is the right thing. But from my perspective, I've never seen anyone do Russian negotiation. It's always been best efforts, because they take their jobs very seriously and they're professionals.
You know, I'm on LinkedIn and I see people post, I see a lot of people in the insurance industry post about most random things. If you guys follow me, I post about random things. I saw one post by the Safeco vice president or president of California, Western region. I'm trying to find the post while we're having this conversation, but he really talked about how at Safeco they were handling some of the claims that would come in, the volume, the size of these claims. And I just said to myself, why isn't everybody else doing it? So, anyways, I want to just get off this subject. That's the last mention I had because I thought, his post should be spotlighted and he should get recognition because, all these big presidents of this insurance company, you earn your paycheck not throughout the entire year, but through these main events. It separates you from everybody else. And I just thought that he did a fantastic job stepping up as leader and posting things to represent his brand, to represent his company like a leader should.
Jeff,
Okay.
let's turn that around. Let's say that, again, a hypothetical. I'm not talking about any particular insurance company. What we have as an industry in the Los Angeles area with the fires, it's a once in a career
Yeah,
situation. And for somebody to be out in front of it, anybody, I'm not talking about any particular company, for someone to be out in front of it and say, you know what, we got this. You have to be careful because as soon as you say we got this, there'll be an attorney that comes after you for saying, well, you told us you got this, and then you screwed up my client's claim. So, I mean, insurance industry really can't win. The best they could ever hope for is to tie. And it's like the 1985 Chicago Bears, right? They said, well, if nobody scores against us, we'll probably win the game. And so it's a similar situation. If we say nothing but do our job, we'll probably be all right. And so I can kind of see where the companies are going to sit back and just try to do the right thing, make every claimant happy, to the extent that it's contractual and it's due to them. And if you do your job, you make everybody happy. I use another football analogy. So Chuck Noll, when he was the Pittsburgh Steelers coach, and everybody started doing end zone dances, he said to him, he says, look, if you score a touchdown, so pretend you've done it before. Be a professional about it. So I get it why the companies are being quiet. Some companies are being quiet, but at the same time, I understand why other companies want to toot their horn. But I don't think there should be a standard for it. I think it's a company specific issue, and we should respect their rationale for staying who they are.
Yeah, just real briefly, thank you. What people have to realize, is the massive investment in claims paying that would be. If this was, I'm going to use since I'm from Louisiana, I'll use the 2020 and 2021 hurricanes as an example. And by one estimate, insurance companies paid out over $23 billion. If they were a private company, as an institution building a factory or anything like that, it would be the biggest investment in the Louisiana's history, from that standpoint. And similarly, over there in California, what people have to understand is that while people want to demonize the insurance industry, right? The insurance industry is going to pay billions upon billions of dollars from these fires that is going to help revitalize that. And if that was a private company or outside investment, right, it would be an unprecedented investment. And then there's trickle effects after that. Usually after the storm seasons in Louisiana with our high sales taxes, guess what? The coffers of local municipal governments, they swell, right? These investments have a multiplier effect. One of the things, hopefully, that you'll see in the Palisades area is that you see a bunch of new, beautiful, modern homes, that will be in place, paid for by the insurance industry, and so no charitable or government type program can ever match what the private insurance market is there to provide. And I think that's also a message that's missing, overall, in this world in which they want to demonize insurance companies and executives.
Yeah, I'm going to toss something else out there. You made me think of it, Matthew. All right, you're rebuilding. I think California years ago, there was a famous Proposition 103 related to taxes, property taxes. I don't know the ins and out of it. However, with 20,000 structures being rebuilt, I'd be curious to know how the tax structure on those properties, the newly rebuilt property, how that's going. Are they going to have the ability to keep the Prop 104 real estate property tax levels in place, or because they're a new build, are they going to come in at the current level as opposed to the one that they used to have? There's a million questions that we haven't pushed through in terms of what's going on there. It's absolutely unprecedented. And it's unfortunate that there'll be people that litigate that uncertainty while people are trying to push through it. But I certainly hope that people who rebuild don't find out that their property insurance taxes are now more than they can afford.
I find the post. So the post is from Scott Johnson, California Regional Director for Safeco Insurance. And the post, he talked about Liberty Mutual and Safeco are here to support our customer and agents during this unimaginable wildfire event in Southern California. Our staff will be available to assist at several locations across the area. Here's the interesting part. Here's the insurance places they chose to assist the customers. Kelly Jiggins Insurance at 45 El Molino, Pasadena. Mementos Insurance in Sherman Oaks, California. And site operation Monday, January 13th. Start at 8 a.m. Palisade Fire victims claims will be at Hub International in Culver City. Additional locations, insurance villages, multiple locations, Santa Monica, Performing Art, Pasadena City College. That was such a simple post. That doesn't say, hey, we're going to pay everything or we're not going to pay anything. That would just post to all their customers and their employees. We're fighting this fight. We're going to go to war and we're going to help our customers, right? Man, that's something that every insurance carrier and execs miss the opportunity to say, we're here doing our job and we're going to do really good at it. And props to all the insurance agency opening their doors to work with their carriers to help facilitate these claims and get their customers in there.
Well, Jeff, let's look at this a different way. I mean, you read that you don't have a property in California, and so it gave you some warm fuzzies, but it doesn't affect you directly. I believe, I assume that there's been companies in California doing that very thing you read about, but they're contacting their insureds, and we don't know about it. But they are doing the very same thing with the people who are affected. So I get your point about, that it's good to get some good public relations and show people you're working. But if someone's contacting their insurers and their claimants, they're effectively doing the same thing. We just don't know about it. So I'm hopeful that companies are taking that direct to claimant approach. And we'll hear about it later when their claimants say, you know what, these guys got to me within 24 hours, 48 hours, whatever it might be. So yeah, I'm hopeful that the companies don't need to make a public post to be doing the right thing by their claimants.
So I think this is a pretty in-depth episode where we talk about a lot of different things from a lot of different areas. What else do you guys see as a trend that we should be talking about? You know what? This is what our third episode should be about coming up. What else is affecting the litigation claim frequencies? Should we talk about hail states, tornado states? And
certainly we can talk about the hail challenges that Colorado and in Texas, particularly the Dallas area, faces. We can talk about roofing. We can talk about standards. We could talk about a lot of the challenges that are out there. When you talk about property litigation, it centers around only a few states, and the states in which those where the law is favorable for recovery, particularly for attorneys. That's really what it comes down to. We can talk about the difference between states in which attorneys' fees are awarded and in states in which attorneys' fees are not awarded, and the frequency of litigation. The lawyers that are profiting off of this to the tunes of tens of millions of dollars. And states where those lawyers aren't there, where there's still weather, there's still problems, there's still challenges, but because the laws don't hand the money to attorneys, there's no litigation, and the effect on rates that has.
Yeah, Yeah, Jeff, you mentioned at the beginning of the podcast, alternative business structures. I think that's something else we can certainly work into the equation, because right now you've got Utah, DC, and Arizona out there, but state of Washington's looking at it. And that marriage, alternative business structures, marries the money with the litigation, with the legal firms. And I think that's certainly going to be part of it as well. So I think, and I think once we get through the January renewals, the cost of reinsurance, there's also be reinsurance renewals in July. So I think, to your point, the litigation, the alternative business structures, the cost of reinsurance, all things that are going to affect the availability and affordability consumers have to see.
And Jeff, I've been doing a series of posts this week, and I'm going to.
I love your posts, by the way. Everybody should go to Matthew Monson's LinkedIn page and follow that.
Well, I also want, in one of our future conversations, and I know Joe and I will be addressing a lot of this. We have a presentation coming up over in Scottsdale on March 12th that evening, and discussing this. But it's the nature and extent, and that will shock everyone as to how much money is being lent to law firms to acquire clients. There's one law firm, and again, it'll be a good teaser for a future episode. One law firm whose website only has 4 lawyers on the website. That law firm just declared Chapter 7 bankruptcy, which means liquidation of the firm, because by their own numbers, they say they owe to funders $202 million, one small law firm in the Houston area. And the magnitude of that is shocking. They operate in the mass tort space, right? But in order to get that far in debt with that few amount of lawyers is a very scary proposition, because these are just the things that we can see in legal pleadings. It's not what's going on behind the scenes. And in my opinion, the amount of money that's lining up to take money from insurance companies is starting to rival the amount of money that insurance companies have to pay claims.
I think that's another thing, Jeff. I know you're recording, but just I don't necessarily want this on the record, but the other thing we could do sometime is, I think it would be fascinating to have someone who's involved in the governmental judicial infrastructure talk about the fact that, you know what, we got the same number of people in 2025 we had in 2015, but we've got 5 times the litigation. I mean, we just can't process it. It's like a sausage factory. I mean, no matter how much you push into it, you still only have so much capacity. I think that's something that people have not discussed enough either. That just the government. What would you call it? What do you call that, Matthew? What do you guys call that structure?
I'm just a general regulatory structure, on how it is. I mean, when you look at the way the systems in a lot of states are set up, and here's, what, again, if we're off the record here, sort of, but to discuss is that, what would you rather invest in, right? Would you rather invest in a state like California, where you can't get the rates that you want, and it's literally a money losing proposition if you write any amount of business over there, right? Or do you want to invest in something that goes to take money from the insurance carriers under a favorable legal environment, where in like Louisiana we have over a 100% penalty on any amount of money that a court determines that you should have paid. It's a smarter investment to me to go after the insurance company money than it is to invest in an insurance company right now, in my opinion.
Sadly, I'll amen that. Yeah.
And the money is just as big, and it's coming from offshore sources. My post that took place yesterday, didn't outline it, but the hedge fund that just lost $116 million, the same hedge fund in that bankruptcy, there is some deposition testimony that's part of that pleading, where the guy goes, yeah, well, we run our hedge fund out of the US, but a lot of the money comes through the Caymans, through our foreign sources.
Yeah.
Which in no way, shape, or form is anything that can be discovered in any kind of litigation. The people don't see it, But that's what's influencing the entire process and making everything more expensive, for everybody. And if you
Well, I mean,
got rid of that, or made it illegal, but the problem is they don't know what to make illegal because they don't know what the heck's happening. And that's
yeah,
that's why Joe and I are getting together in
yeah,
Scottsdale and starting that in a very granular level to try to
yeah.
talk to as many C-suite people as possible.
Yeah, I mean, when you go back to this concept of technology-enabled claim instigation, use of the internet, litigation platforms, the funding, the marketing, there are no borders. There are no borders. I mean, you got people in North and South Korea, the Philippines, Japan. Everybody's can do something that affects the United States. So it is genuinely problematic because who's in charge? I mean, you pass a law in one country, but it doesn't affect the other 195 countries. I mean, we're truly in unprecedented times in so many ways. The
Right.
the claims in Los Angeles is a very practical, tactical, unusual event that'll hopefully never happen in our lifetimes again. But even the claims harvesting that Matthews discovered, the tech-enabled claim instigation that our research and Todd Kozakowski's findings discovered, these things never existed before. We have a whole new set of challenges to address. And until we admit that they're there, we got problems.
Right. And in general, because actuarial science is backward looking, right?
Yep.
And Joe, correct me, right?
Yeah.
It's backward looking based off of past experience.
Yep.
It's not taking this stuff into consideration going forward.
It's extremely difficult for a Department of Insurance or a regulator of any type to accept a prospective thought or a prospective process. They're much more interested and comfortable in looking at past history. And Jeff, to your point, the other thing that's probably worth a discussion is why isn't the industry taking a more proactive approach of talking about why it's trying to do the right thing with its claimants and its policyholders? I mean, is there, why are they scared? And why do some do it and others don't? I mean, that to me is another area where we as an industry need to figure out, how do we get back? Because I'll say this again, and again, I know you're recording, please don't use this. My personal opinion, trust in the insurance industry, I don't think it's ever been lower. I don't know where they measure that, but I'm willing to bet that nobody trusts us more today than they did 10 years ago.
That's something I have to agree wholeheartedly. That is just a sad state of where we are today. And maybe we can pick an episode to talk about where are some of the states that's on the front line, that's doing the right things, that's making the right trends. And maybe we can use our downtime to think about what are good example of states to talk about. But right now, there's nothing come to my mind. I can't think of one state that like, oh wow, they're doing the things that every other state should follow. Like, I can't come up with one right now.
Well, I mean, you're exactly right. Look at the reforms that Florida pushed through in 22 and 23. And yet right now, after all that residential reform, they've got a condominium crisis. It's like you can't holistically address everything. Yeah, I mean, it's impossible to get the legislature aligned, the consumers. I'm with you.
Joe, thank you for all your inputs, and Matthew, thank you for all your inputs. So this way that when our audience listen to this entire audio, you're now getting everything that we recorded for the podcast, and even the stuff that we meant to talk off air, that you're going to get all of it, because we are people who actually care about this industry. We love our community of 7 million plus insurance professionals, and we care about the insurance industry, and we really care about where we're going as a whole industry. So I really applaud these gentlemen come on here and giving their expertise, their advice, and talking about things that are just so uncomfortable. So we're looking forward to the next recording, the next episode, and thank you again.
Yeah, thank you, Jeff. And if I could just add one more thing, and I don't want to take the last word from you as the gracious podcast host, but in addition to caring about the industry, I think everybody on this podcast in particular cares about the policyholders, right? And really the whole idea of insurance companies and the attorneys and the plaintiff's attorneys, defense attorneys, everybody involved in the process has to remember to put the policyholder first. And we care about them. We see the things that are affecting people. We know that the struggles that the policyholders are facing nowadays. We obviously, as we are all policyholders ourselves, we share it. We feel the same pain that everybody else feels, and and we're here because we want to try to shape the discussions and encourage everybody involved in the process to do something about it.
So thank you again for the tuning into this whole episode, and I appreciate everyone's time to joining us, and also appreciate your time for listening. And until the next one, thank you.